All right. Good evening, everyone. My name is Narender Agarwal from Wealth One, and we welcome you to Returns and Beyond webinar on PMS and AIF. So, Wealth One is a platform where we have a lot of data and a lot of work happening on the PMS and AIF front for the benefit of the investors and fund managers and the research analysts. So, make sure that you log on to our Wealth One website and just have fun with the data round. But today is something very special because we have a man who has been into this industry for 2 decades. Please welcome Mr. Naveen Chandramohan from ITUS Capital. Naveen has been a great player, especially he has worked with Lehman Brothers, with Nomura, and also with Hutchin Hill. And now he has launched his own capital called own PMS fund called ITUS Capital from 2017 onwards, has been giving great returns and been managing 1300 CR as assets under management. So, ladies and gentlemen, please welcome Naveen Chandramohan to this webinar.
Good evening, Naren. Thank you so much for having me on this webinar, and thanks for the kind introduction again.
Thank you so much. So, Naveen, this is going to be an interaction where I'm sure that the clients, the investors, the viewers, the audience of Returns and Beyonds are going to benefit from your extreme knowledge. So are we going to start right away?
Absolutely, we are.
All right, that's great. So, Naveen, what is happening in India is that we are seeing a lot of influx coming into the equity markets, financial markets, where there is a lot of awareness. So we see the number of demat accounts been going up. The number of mutual funds has been astronomically going up. And there has been a great interest happening in the world of PMS and AIF also. Okay. So as a fund manager, my first question to you is that, for example, I am an investor and I have, let's say, 5 CR to invest. Okay. How do you allocate this, or how should I be allocating this to different platforms, whether it is direct equities or mutual funds, PMSs, or AIF? What should be my mix, and what is the rationale behind it?
Naren, obviously you start off with a difficult question, but let's go about trying to build some structure into this, right? Let's take the easy part of it first, which is direct equities. I think first, as an investor, one needs to appreciate that investing is a full-time job. Of course, everyone is passionate about investing. So you can obviously take some money out of it. At the end of the day, it's your money, right? So you can manage it or you can apportion it the way you feel appropriate, but have it as a passion bucket if you're going to be doing it yourself. It's perfectly fine. I know some extremely smart investors who want to do it themselves. There is nothing against it. But end of the day, have it as a process, because it's not meant to be done by talking to other people. If you believe you have understanding of certain businesses, 200% you should be running your own direct equity portfolio to the extent that you feel comfortable. And if you can benchmark yourself, because end of the day, you are accountable to your money too. Right? So even if it's a passion bucket, you have some accountability to it. And if you feel that you have the ability to pick stocks, by all means. But if that's not the case, then you have the 3 buckets that you laid out. To me, whether it is an MF, PMS, and AIF, I personally think of it as the same. Right? I know it's a controversial statement to make, because end of the day, it's a wrapper. Right? Each one of these wrappers are investing behind equities. MFs have their own categories that they are bound by. 7 years back, when I started the fund, many investors used to talk about running or allocating to PMSs because MFs could not concentrate. Today, MFs can concentrate too. So, end of the day, if I, as a PMS, say that I have a superior right to pick stocks, I'm not sure that's a very sensible argument to make, even though I'm from the PMS industry. Mutual funds, in fact, have much higher and smart people too on their platform. So I would not distinguish it as MF, PMS, and AIF. I would bring in a slightly nuanced discretion to this. I think when you are starting out, MFs are a great product, right? And if you believe that, let's say you have a 25-year investing journey in India with various products, and if you've built a one-on-one nuanced relationship with your mutual fund manager, then by all means, you should be happy with an MF too. The role of a PMS and AIF comes in, according to me, because there is a certain strategy that they follow that you understand, and bar or the fund house can service you better. The entire aspect of saying that PMS and AIF have the right to generate higher returns, I'm not very sure I buy that. From our perspective, it's always been, do we have the right to protect capital better during downturns and allocate capital in terms of capturing upside during upturns? That's the basis around which we set up ITUS. It was not to basically say that we will beat an MF in every year. I don't think that's a sensible argument. So for me, I think if an investor can build a relationship with an MF manager, I think more often than not, their needs will get taken care of. But to do that is hard, unless and until you've been in the markets for 25, 30, 35 years. Over time, if you can build and take that relationship into a PMS or an AIF too, I personally believe that's where a PMS and AIF fits in into your portfolio. So that's broadly how I think about it. If the investor does not work with the fund manager, right, PMS and AIF may not make so much of sense. That's the part of customization and thinking through how a fund manager can add value to you, specifically during bad times or volatile times. And that part of service is where a PMS and AIF generally tends to add higher value. So to go back to the original question, how do I allocate between the three? I don't think that's the starting point. The question is, how actively do I want to be involved with my money as the money corpus scales up? Because a 10% of 5 crores is going to be very different from a 10% of 1 crore. Though the percentages are the same, people psychologically react differently. So this emotional aspect of how you deal with that 10% drawdowns is why you should consider a PMS and AIF. That's how I think about it.
What I understand is that as far as direct equities is concerned, it is not a part-time job; it's a full-time job, and that is how people should look at it, and not rely on WhatsApp and Instagram universities to be their guiding light for this. Yeah, and of course, stepping stones is first get into mutual funds and then slowly graduate to PMS and AIF. Is what I understand from what you said.
Absolutely, okay. That would be the outcome. Yes.
Perfect. Yes. So now, just talking about that's moving the focus to the most important, the most talked about subject in these days, and that is gold and silver. Okay, and we see that gold and silver has been reaching the heights which have never been perceived, or which were too far away in timelines for people, and then they just got in. With those kind of figures that the gold and silver has. China is out there buying outrageously physical gold and physical silver, which is kind of creating the entire shift of momentum happening in gold. So for my first question is that do you see that this leg or this extreme momentum is over, or there is some steam left into it? Or also, what would you advise to our investors going forward from here?
Okay, so I think, Naren, for me, advice is free and cheap, right? So before going to advice, let me talk about the thought process. And this thought process has held true since the 70s. I'm not going to make a sweeping statement and say asset allocation and gold should be a part of your portfolio. It's more important to think about a framework of why. What is gold? Because end of the day, it is not a free cash flow yielding asset. right? So historically, equity managers have said gold does not make sense. I'm not sure I agree with that statement either. Gold is effectively a proxy for nominal interest rate change, along with inflation, along with currency depreciation. These three put together as a package is why gold makes sense. So, for example, if you talk in terms of US dollar terms, your nominal inflation uh, last decade was low at 2 to 3%. Right? This decade, it looks like you should price in a slightly higher nominal. Let's call it 1% higher or 1.5% higher. So what was 2 to 3 last year, this decade should look like close to 3 to 4, 4.5 ballpark. Then you have your nominal inflation. Sorry, nominal interest rate change. Last decade, that was on a declining trend. So your nominal was roughly around 3 to 4%. This decade, you should assume it should be higher, closer to 4 to 5. So if last decade, and you would not assume dollar depreciated in the last decade because it was the reserve currency and it still is for all practical measures. But today, or rather in the last 2, 3 years, because you started off with a statement saying China is buying gold, what does it mean? They used to buy treasuries. Now they are buying gold, which means they are making a fundamental assumption too the dollar is going to depreciate. Right? So that last decade, you would not make that assumption. So in the last decade, you should expect gold in the long term to give you anywhere between 4 to 6% in dollar terms. And this decade, that should be closer to 7 to 8% in dollar terms. Right? Now come to INR, because we're talking to Indian investors. There is an additional leg that you price in the form of INR depreciation too, because we are talking about our currency, which is around 3.5%. So in last decade, 4 to 5% in dollar terms roughly works out to around 7.5, 8%. This decade, that should work out to 10 to 11% for INR, right? That's your base case assumption. So when you say, should you buy gold? You should think of it as an asset class. If I was to tell you equities will give you 10 to 11%, what value of your portfolio would you put in equities? You have to take that call. Similarly, if I'm telling you this asset class is going to give you 10 to 11%, you have to think about what percentage of your net worth are you going to put. For some people it could be 10, some people it could be 20, if you thought about it this way. Now, to put this into perspective, the last rolling 10-year return for gold, as we speak as of last month, stands at 16 and point, roughly around 16 to 18%. That's the rough range in the last 3 months. So if you expect it to be 11.5 to 12, you are at 16.5 to 18, which means there is a high probability in the near term it can course correct. But that does not mean you should not own it, right? So you will have to assume short term can have a correction, but this decade doesn't mean that you will not make returns out of gold. You should not think about it from a momentum chasing asset, because I don't think that's how you think about it. You think about it as a 10 to 11% return yielding asset. And from that perspective, what percentage of your portfolio needs to be there? If you can orient your mind this way, I don't think you will react to short-term moves like it going up 10% in the 2 months or going down 10% in 2 months. So that's the framework I would like to communicate to investors around how they should be able to place their allocation into gold.
Fully understand that, Naveen. When you say that this decade is for gold, and there will be reasonable returns that you will be making, we're sitting at 2025. So we will. Would it mean that we have next 5 years of good run for gold as per your calculations?
So think about it this way, right? You have front-loaded your returns. If your mean return is between 10 to 12%, let's take the higher end at 13%. You are today at 18%, which means over the next 5 years, you have already borrowed some part of it. So if you're allocating today, over the next 5 years, your CAGR might be 9%. It may not be 13 to 14%, because then your rolling tenure normalizes back to 13. So you cannot go into this asset expecting a 18% return, which is what people got over the last 10 years, right? Just to rewind, in 2021, China was still buying central banks. China's central bank was still buying gold. The rolling 10-year return standings December 2021 was 4.1%. Today, that same rolling 10-year return is looking like 18.1%. What I am saying is over the next 5 years, absolute returns, you might still come out making roughly, let's call it ballpark 45 to 50%, but that will CAGR annualize to around 8 to 10% because you have to mean revert. That's all I'm saying.
So that means how we traditionally see gold and silver as hedges against the equities and we see any kind of a
So I think
geopolitical.
that's how it has reacted from time to time. Rather than looking at it as hedges against equities, I would look at it as hedges against nominal interest rate increase. And see, again, typically, why did it become called as a hedge against equity? Because when nominal interest rate goes up, from a discounted cash flow, equity valuation goes down. That's the reason people started calling it as a hedge against equities, but it's not, because from 21 to 25, globally, every market is up and gold is up. So where is it a hedge against equities? So it's a hedge against interest rate going up and it's a hedge against currency depreciating.
Okay. So what I understand is that, of course, as per Naveen, is that you can see certain corrections in gold because it is certainly shot up, but then there is a reasonable time and reasonable time frame for the gold to make some realistic money and realistic returns from it, is what we understand. Yeah. So Naveen, just shifting focus from gold to getting into the investor mindset. Okay. So a lot of investors that I have interacted with, being into this financial market for some time now, um, investors claim to be long-term investors. Okay. And the moment they see a 10% drawdown, the panic button sets in. Okay. And they're not able to digest that correction. They're not able to digest the drawdown that comes in. Which makes them make some hasty emotional decisions, which they later regret. Yeah. So how can you distinguish between the conviction and an emotional decision for a investor who claims to be a long-term investor? And with the long-term, I mean 3 years, 5 years, 10 years horizon is what I mean by long-term investing.
See, Naren, I think I always say this in jest, right? Every investor can only be long term if they don't see the value of their portfolio. That's the reality. So we can keep preaching long term as much as you want, but end of the day, you can't fight history of human emotion. And every investor is bound and should react when the market falls 10%. That's the reality, because today, when me and you are talking, when the market is close to 26,000, it doesn't feel like the market will fall 10%, or maybe some people make an assumption it can fall. When it falls, it's with a host of news that we did not price in. So it's not easy to basically say investors think long term. So the only thing that we as fund managers are responsible for is, can we at a fund level during each one of these drawdowns fall lower than that 10% that the benchmark falls? So end of the day, what you can go and tell your investor is not about don't panic, everything will be fine at the long term, because end of the day, they're tired of hearing that. What you can go back to the investor and say is, see, this portfolio is slightly more robust because it's fallen lesser, has better fundamentals, and you should see it rebound as much on the upside too. That I think is slightly more comforting for the investor to hear. So I'm not preaching long term. I think long term is always going to be a series of short terms. And in the short term, if the market falls, and it can fall during any point of time, can you as a fund manager position your portfolio such that you fall lesser? Now that can be through a combination of both sector positioning and good stock selection, both in tandem. So that's broadly how I think about investor emotion. Second leg to your question on conviction. See, I think conviction is an oversold concept. I mean, again, let's take me out and let me talk from a slightly more neutral perspective. I'm not running the company. I'm not the CEO. I've not been working through the nuts and bolts of the company. I'm having calls with the management. I'm meeting them maybe once a quarter. I'm doing channel checks. So, what conviction do I have? Right? If I'm honest with myself, conviction gets built because valuations are cheap. That's the only conviction as far as I'm concerned. The rest of the time, anything can go wrong. That's how you think about risk, according to me. So I don't think it's good to say that I have conviction. If you have conviction, then my turnaround question will be, why not invest in 2 stocks? Right? Why do you want to build up a portfolio of 30 stocks?
25 or 30
30,
stocks.
35, whatever number you're building. So
Fair enough.
this concept called conviction is a bit of an overrated concept. I will also play conviction if you give me a 5-year locked up fund, because then you cannot pull out of money. End of the day, if you have access to your money every month or every day or every week, which is what most public equity fund managers do, then conviction, end of the day, comes through good risk management rather than you saying this business has to do well. So that's how I think about conviction.
Great, yeah, that was very informative, and a different perspective to how we as investors feel and react to certain situations. And this is how a seasoned fund manager does, and how he thinks. So this is for our audience. We're talking about conviction and emotional outbursts happening at the times when it is not favorable in the equities market. So we have a man here who was in the epicenter of the 2008 crash, the epicenter of the Lehman Brothers. He was part of the Lehman Brothers team at that time, and that's the time where the ultimate play of conviction and emotional outburst, having your having you getting an opportunity to see how people around you react, how the world around you reacts to a global meltdown. So, Naveen, we would love to understand what exactly happened in 2008 when you were in the epicenter of this whole issue, and how did it play out on your psychology? Although you may not be having your own funds to be invested at that time, and you must not be having your personal stakes at that time, but I'm sure that the stakes of your investors, your clients, your company, and everywhere, things must be flying around. So what is your take on this entire? So I want you to walk us through this exciting journey of yours for the audience.
So, Naren, I think if I have to walk you through a sequence of events, I need a few days. Right? But considering we have a few minutes, I'll just summarize.
Yes.
So September 15th, 2008, that's when we filed for bankruptcy as Lehman. And I say we because for me, it is still a part of me. I hold that firm with very dear to my heart because that's where I began my career in Tokyo. Right? And every one of us I work with have a very similar feeling back then. I'm fairly sure of that. So September 15, 2008, that was a Monday morning. That's when we filed for bankruptcy. September 12th, 2008 was a Friday morning. Stock was roughly around, I don't know, $3.40, rough ballpark. And my boss's boss's boss, who was on the board, who was the head of Asia, who was on the board, came out to the trading floor and said, this is a buying opportunity of a lifetime. Again, to put it into perspective, conviction from the person who was on the board. You cannot get better conviction. And obviously, I was a vice president. I was fairly junior. We're talking about someone on the board. When someone on the board says buy, to our capacities, we all buy. Right? So we all bought Lehman stock, and we all also felt proud about it because we were supporting our firm. And little did we know Monday morning, we don't have a firm to work for. So that was the sequence of events that unfolded around what conviction means and what can actually happen, right? So this is broadly explaining what actually happened in those 2 days. If I was to explain what happened 6 months prior and 6 months post, I obviously need a much longer time with you. But just to give you a perspective of what those events were like for me personally, but I cannot tell you how much what it taught me. To appreciate art, to appreciate science, to appreciate humanities and psychology. That's what that event actually taught.
But I'm sure that once you walked out of Lehman Brothers, you must be a completely changed man with having a changed perspective towards financial markets. The kind of experience you must have got in that small time is will be invaluable, priceless.
I mean, it humbles you, and it tells you that beyond the point, you don't know much. So all you can optimize for in terms of fund management or managing money is managing risk. So you manage for downside. So those lessons easier, obviously, when delivered in a book or in a webinar like this, easy to accept. But when you go through it, it's a different experience for sure.
Absolutely, I totally agree with that. I'm sure that this is one experience that anybody will die for, to have it, to be in your shoes at that time. Naveen, this is exceptional. Okay, talking about the risk, the drawdowns, the downsides. Okay, so ITUS Capital launched its PMS, the multi-cap PMS, in 2017. From 2017 to 2025 journey, if we see 2018 corrections, we see 2020 COVID crash, we see 2022 Ukraine war crash, we see 2024 corrections again coming in. So how is it that the ITUS Capital manages its drawdowns? Because as an investor, the ask is always to create some alpha. What is it that you are getting us for us on the plate? And once the drawdown comes, of course, there is a certain kind of um, trust that goes haywire. Okay, so what happens inside your war room is what we need to understand when these kind of events play out, and probably they've been playing out every 2 years for you now from 2018 onwards.
So let me first lay the data on the table, Naren. I think we've managed all drawdowns well, barring the one that is the recent one, end of 24, early 25. Right, that's where our drawdown was, if I can say so, poorly managed. Primarily because we were overweight pharma and underweight financials, and for the first time, both hurt because of an extraneous news from tariffs. End of the day, that's still not an excuse. That was poorly done. We made some changes, and you've seen the outperformance since then. So to put it into perspective, I just need to lay the data first around, have we managed drawdowns well all across? Barring one, I would say yes. Now, where do we come from? We come from a school of thought that markets operate in cycles. When I say markets, I translate that into sectors, and I translate that into companies alongside, which means one of the core jobs of a fund manager, according to me, is positioning of the portfolio as much as picking the stocks. So everyone talks about picking stocks. I call it table stakes, but positioning where you want to be overweight and where you want to be underweight, depending on what cycle you are. Right. So, for example, not all sectors, there are some great businesses, they continue to be great, but if it's in the wrong cycle, will not generate returns. And we've known multiple examples of that. For example, many marquee banks between 21 and 24 did not give you any return. Some banks, much longer periods. Some consumer companies between 21 and 24, no return. So you can blame it on valuation, but I don't like to use the word valuation, because I can give you umpteen examples of 100 PE companies which have given you 4x returns, and 30 PE companies that have not given you any returns. So this anyone who uses the word PE as the only benchmark around why they want to buy or sell a stock, I'm not sure or rather they don't cover the full picture. For me, it's more a question of where is growth, and for the growth, how much are you willing to pay up, because you cannot get growth cheap. Right, that might happen during a COVID, and that's one-off. In the last 8 years, that's a one-off event for us, right? Or in the last 15 years, you might get 2 to 3 such instances. So you can't wait and say, I will wait for the code, like even till then or not invest. So what you're basically doing is positioning portfolios. So what you call as a wealth manager asset allocation, I call as a fund manager sector selection. It's very similar. How do I want to be overweight or underweight, depending on where we are in the cycle? And basis that, how do I position from a bottoms up perspective, pick companies? So end of the day for us, top down, bottom up, merge together. And that's where I think about portfolio positioning. What is our right to protect portfolios during drawdowns? The only right is because of growth. The only way I think about positioning, as long as you don't pay egregious valuations at a portfolio perspective, right? If you look at our portfolio today, we do have companies with much smaller weights, though, with 100 PE, but they are growing at 45%. But we adjust that from a risk management perspective on the position size. Because end of the day, what I'm concerned about is when things go wrong, what kind of drawdown am I facing? So if you can manage that across time, then over time, even during rough times or good times, invariably such portfolios should actually fall lesser during bad times and hopefully do much better in the market during good times. So that's the fundamental philosophy that around the framework that we think about.
Brilliant, brilliant. Fully point taken, and we totally agree that the 2018, 20, 22 drawdowns were actually working in your favor somehow, and that's where we say that the fund manager strategies plays out well if you're able to preserve the capital of your investors. Okay, just going to the macros of our country. Okay, when we see India as a whole, and India as a financial global hub that is getting into place. We see that a lot of macros are in place for India with UK trade agreement, with our relations with Russia hitting the roof, our relation with China now getting onto that friendly zone. Okay, we are seeing that the entire thing is playing out good as for the India story, the India growth story is concerned. So first, I want to have your take on the India growth story. How does Naveen see this?
So, Naren, I think you've already laid it out reasonably well, right? So, the only thing I'll add is the growth story is on a very firm footing today because you have a government which is extremely oriented towards action and growth. In every step of the way, they have been extremely committed. I have not seen this from both the RBI and the government in 20 years. Generally, we are used to giving in the right and taking from the left, right? That's what I have seen. And most people will acknowledge that if you lived in India long enough. But for the first time, these measures are very clear cut. And regulation also has been lightened in order to ensure credit flow through. So I think from a macro perspective, you cannot find too many breakages here, or you cannot find too many faults here. I think this is the best macro that the government's balance sheet is in, and more importantly, Indian corporate balance sheet is in. So you cannot get a better macro as far as I'm concerned from a top-down macro perspective.
So also just to add to the macros, we're having the best of the inflations sitting at 2%. We have GDP sitting at 7%. Then why is it that the Indian market is just not moving? Okay, if everything according to you is in place and the US markets are hitting an all-time high, Japan market is hitting an all-time high. For all that matters, Pakistan market is hitting an all-time high. And why is it that we are seeing India, the Nifty, lagging at 25,000 levels, 26,000 levels for a very long time now? So what is it stopping us?
So I think, two things, right? One is if you look at it from the domestics perspective, the flows continue to be strong. And I think that's structural. So in another way, what you are asking is why are FIIs not coming in aggressively? Right? And I think from an FII perspective, India is one part of the overall puzzle that they invest in. Today, everyone is chasing a certain theme, right? For example, this theme is driving 95% of the GDP of the US as we speak, which is AI. Right? So, rightly or wrongly, that's the theme people want to invest behind. And when you don't have that theme to offer, then you need to offer something else, which is called growth. And Indian corporate earnings over the last 1 year, 4 to 5 quarters, have been muted at best. I personally believe in the next 2 quarters, you should see this change. And broadly, I think, well, AI theme, we may not have a great set of listed companies for the markets to get excited about. Growth should come back. So typically, FIs come through during one of two reasons. A, 1 or 2 years of significant currency depreciation, and bar or growth being reasonably above average. Today, you have the first criteria fulfilled. You are in the second year of a reasonably strong currency depreciation, which is INR. What people don't see is USD is actually depreciated alongside. So yeah, INR depreciation is actually, it's a double whammy for us.
Yes, it's even
And
higher.
it's much higher. And your growth, which has not come through, should come through in the next 1 to 2 quarters. So I think if you can look slightly forward, and I'm not saying 2 years, 3 years, be long term, I'm saying 2 quarters out, I think we should be in a slightly different situation. It also depends at that point of time, relative risk reward, where other countries stand. But I think FII flows should come in, and you should see a slightly stronger market going forward.
So that means Naveen, as a fund manager, is bullish on the next 2 quarters coming in. Uh, for
Let me put it this way, bullish, bearish, I don't know. What I would say is if 100 rupees is given to me, I would want to deploy this over the next 3 months. I'm not of the camp of keeping significant cash.
All right. Point taken. So when we talk about the most talked about deal, and that's the US India trade deal, which is on the offing for a long time. And there has been a lot of speculation happening with Trump giving some statements in the morning and then retracting those statements by evening. Modi and Jay Shankar being very lip tight about the US India trade deal. So, what is your take on it? Is it going to really come through? And if yes, then what is it all going to be about?
So again, so first, when you ask me such a question, right, my first narrative is, am I even qualified to answer that? Because even if I say yes, why should you even take my answer, right? It's not like I work for the government or I have an in into the government. And even if I do, everyone had an in into the government in Jan 25. Everyone said that US India is going to be the best thing. We have smooth sailing. It's always India shining. But that's not what turned out, right? So I think what I'll tell you my framework of thinking about it, having gotten it wrong in Jan 25, is the reason we got into this situation because we were a pawn for the US to work out a deal with Russia. That's my fundamental belief because they did not have any other way to get to Russia. So hence, we were given the short end of the straw. And today, that is what is coming out in the open, where basically US is saying, don't buy Russian oil, hence I can put sanctions. And if I do it, I have an alternate from either the Middle East or the US themselves, because they have been drilling too, for you to take over. Whether we do it or not, I think there will be some negotiations. So I think we are in the late stages of that. The reason we got the short end of the straw is because of this. And I think somewhere in the next few months, there will be a deal. In what form, I don't know. But any form of a deal is better than uncertainty every day. So that's how I think about it.
So you want this deal to be closed ASAP, and whatever comes in front, so that we are able to take certain kind of positions according to that.
I think the government is smart enough. They don't want to be put in a corner either. So they've also made their stance clear that certain sectors they're not going to budge. So I wouldn't say whatever form of the deal. I think the government is filled with very smart and sensible bureaucrats who know what they're doing. I think it will be in a stage where India doesn't get affected, or many of the smaller business, some sectors could be, but broadly, give or take, we should be okay. That's broadly how I think about it. And I think going into the year end, we should see something. That's my basis.
And that is what everyone is also praying about, that this deal should come through, and so that we have that last bit of hitch that is stopping us should also go away. Well said, Naveen, on that. Okay, let's shift some focus onto your sectors and the sectors that you are betting on as a PMS in ITUS. And we see that you are mainly on the large caps, 50%, and the rest of the 50% is divided into mid and small caps. Also, when we watch onto the sectors, financial services is having some good weight into your investments. So, just want to understand: do you see Bank Nifty uh, is going to going to have a breakout from here, or do you see this as a value trap as a fund manager?
I don't see it. And so, okay, value trap, I don't think so. End of the day, I think financial services will grow in line with GDP, maybe GDP plus. So if you assume a 7.5% GDP, which should come through next year, you should see your lending growth coming through at roughly around 8.5, 9% at a system level. So there are going to be select banks who should do 1.3, 1.4 times system growth. The last decade, these banks were doing high teens. This time around, they will do low teens. So what that means effectively is your NIM margins may not expand aggressively, and ROA expansion may not be as aggressive as what you were used to, because you have enough and more competition as well. So I think bank index should do in line with GDP plus. So it's certainly not a value trap, but to expect more than a 15% IRR from this space, I think is very hard. So that's how I think about it in terms of the banks I own. They have a space because they have a certain role to do in the portfolio.
All right, point taken. Just having a little view on the healthcare. So you also kind of invested into healthcare, into hospitals, capex, or maybe CDMO, CMO. So when we see all these four categories or the subcategories of healthcare, what do you see now in the near future playing out more? Is it going to be the capex or the hospitals, or the CDMO, CMO space that is going to play out according to you in the coming next quarter, 2 quarters or so?
2 quarters is a coin toss at best, but slightly longer duration. I think hospitals as a sector, I think you've gone through the best phase of returns. From here, you will have to be slightly more cognizant, because every hospital is expanding their bed count by at a minimum 40% over the next 4 years, and some hospitals by almost 100% over the next 4 years. So this 4-year period of this kind of capex expansion we have never seen, right? So of course you can justify it by our population, unorganized moving to organized, but end of the day, when the market is aware of this, like it is, it shows in your valuations as well. So I think there is a hospital that we own, but I think one has to be bottom up. It's certainly not cheap as a sector, but I think again it's a compounding story here. Now in terms of pharma, it's a fairly complex sector. I wouldn't say that we are experts, but we know certain companies well, primarily because they are more of innovators. When I say innovators, you can easily see that from their gross margin profile, the kind of companies they actually work with, and the fact that these companies in the US work with them as one or two other alternates at best, because the process chemistry becomes complex. So you would want to invest and pick those companies. Of course, there are potentially US-based generic companies as well, where the pricing pressure has come down versus what you saw between, let's call it 18 and 22. But again, they are not going to give you long-term returns. They could actually give you 1 or 2 year returns. So each bucket has a certain role, according to me. I wouldn't want to club everything under one. But yes, like you rightly said, we are overweight this sector.
And capex is driving more of the weights in your sector. Is that correct?
Capex, yes. Capex is, so again, the caveat is you'll have to go into whether a company is doing greenfield or brownfield. If you're doing greenfield, it typically takes 2 to 3 years at a minimum for your capex to go live. During that period, your ROIC could depress. If you're doing brownfield, you can actually go in faster. So you will have to slightly distinguish what kind of capex you're doing and how quickly can you actually go live, and is there operating efficiency that you can actually leverage. And that's where I spoke about going bottom up on the hospital space.
All right. So going to my favorite sector, and that's metals and minings. And I'm not going to talk about gold and silver now. I'm going to talk about rare earth minerals that India has been talking about. Um, so lately, China was the only country which had these minerals, and now India is claiming to have discovered, and they're going all out on rare earth. So what is your take on this particular segment, and how is it going to play out in the next few couple of years coming in?
So, Naren, first the caveat is metals are extremely cyclical, right, as a sector. So, you certainly you want to be investing in this sector kind of as a no-brainer when price to book is less than one, where you're getting the stock at less than replacement value. That's
Mhm.
certainly not the case today, which
Mhm.
means you are kind of dependent on free cash flow from these companies getting generated at a time where demand is accretive, depending on which segment of the metals you're talking about. And there are sub segments. You can do steel, aluminum, copper, zinc. You have the entire value chain. Now, rare earth is a wannabe, is like that's looking into the future. So, if you're asking me, are we betting on rare earth? Answer is no. If it happens, then it's more of luck rather than anything else. So that's more of what I call as great to have, but that's not what you are actually risk managing to. You are risk managing to the current business, and if some upside comes, then that's your optionality. Whether you call it P rating or whatever, it's all the same as far as
And then
option.
probably then you will evaluate to jump into it once that framework is set. Yeah.
I don't think if something happens, I would want to jump in at that time. At that time, I'd start thinking about how to trim down risk. So again, you cannot buy a hype cycle in metals because you
Okay.
will get killed on the other side.
Okay, so let's talk about a cycle where you're slightly underweight into your portfolio, and that's the tech. So the new age companies, Swiggy, Paytm, Eternal. Uh, I just want to have your view on this. How are they playing out as per your strategy?
So quick clarification, Naren. We are underweight legacy tech. We are overweight all of these companies you spoke about. Right.
So yeah,
So
okay. So I want to have your view on these new age companies as to how do you see them playing out from here?
So again, new age, old age, I'll again try and avoid using jargons because then it feels like we're making something sexy when it is not.
Okay.
What you are basically playing is a space which has consolidated and now has pricing power. Now, because they have consolidated and have pricing power and they are a consumer oriented business, they have platform characteristics that they have built over the last 10 years. And hence, what they have done is they are moving your distribution GT channel into a new category altogether. Right? So, what is their right to grow at 35-40%? Their right to grow at 35-40% is not because they are called new age. They are moving a certain category, what we used to call 7 years back general trade or modern trade. A lot of that share is moving into what you call a platform oriented business.
Mhm.
So not only are you gaining market share, but you're also capturing the consumption trend. So you are capturing channel. When you capture channel, that's a very powerful trend. Normally, channel capturing happens by 15-20 players. Take wealth management for an example.
Mhm.
Sector one has to be extremely bullish on. That's channel capture. But look at the number of players who are capturing the channel. Right? As against go into what I call as consumer tech, you have 2 to 3 players capturing the channel. So you have competition coming down, pricing power going up, market knows that and hence is paying up. So you have to risk manage that in the end, because in a market where interest rates are falling, terminal value gets accreted. So you have that macro also in your favor. So that's the reason we own these platform businesses.
All right, that's wonderful. Thank you so much, Naveen, for all that insight, and also for our viewers. We would be taking up a question answer session, and you're free to send us your questions on the chat or to WhatsApp us ASAP so that we can ask Naveen the questions that you wish to ask. And I would be I would like to switch on to my nearing to my last questions, Naveen, and that is for you. Is that the AI is getting bigger and bigger by the day. And what I see in the Indian tech is that we are nowhere close to reaping the benefits of AI because we are more service oriented tech industry in India. So what is your what is how do you see this tech playing out in this AI boom that is coming out?
So I think you are right when you say that our legacy companies have not invested in AI. But I think if you think about it, there are many companies which will be beneficiaries of using AI, right? So rather than thinking about, okay, we don't have an NVIDIA, sure. We also don't have an Oracle equivalent, sure. But there are many companies who have been built with a product first, technology first layer. For example, in the travel space, for example, in the insurance space. These companies will be leveraging AI, they already are, in order to transform and bring efficiency in their business. So on the top line, they were anyway growing at 30-35%. Now they're going to have margin accretion in the form of managing costs as well. So you will have non-linearity both at above the level as well as below the level. In terms of above the level, I'm talking about above GP and below GP. So that will have non-linear impact on EBIT. So yes, you are right. We don't have those layers, but I think there are proxy players around beneficiaries. What you will also see is data center like companies which will have impact on ancillaries. So you will have power related capex coming through in a big way, because roughly 35 to 45% of your data center cost even today is power. So you will have to optimize for that. So there are other players to do this through, but obviously it's not going to be as big as US or China or Taiwan, but the opportunity set is still there.
All right. Thank you so much, Naveen, for this. And we have a question coming from our audience, Mr. Ramaswamy. And he says that Naveen talks about 2008 crisis everywhere. I want to know if 2008 happened again today, how would you react differently?
See, answer is predicting crisis is a fool's paradise, right? So if I tell you that I know when a crisis is going to happen, I don't think someone is being honest. What you can do going into it is before a crisis, there is a very strong euphoria. That's how crisis. The word crisis comes because you went into it with an euphoria. Right? When there is no euphoria, a crisis doesn't come invariably, unless and until it is some tail event like a COVID, where you didn't go into it with euphoria, but it took everyone by surprise. So there again, positioning matters, risk management again matters, but you live through it because you come out gentle, because you have a slightly optimistic view of the world. So I think you avoid euphoric sectors at that point of time. You will get into a euphoria in AI soon too. It might be 2-3 years. At that point of time, if you're going into euphoria, and I think then you have yourself to blame. So rather than avoiding a crisis, you avoid pockets which results in euphoria, because those will be the precedent of the next crisis. That's the best that you do, again, from a positioning perspective.
But then if you find yourself inside that crisis once again, irrespective of the sectors or the things that you have planned to take or own, how will you react to it is what we want to understand.
See, end of the day, if you play Wimbledon finals once, you will be nervous. The second time, you're better prepared. Similarly, if you've gone through a crisis once, you don't understand what's happening. Second time, you're better prepared.
You're better prepared.
So how you react to it is what is going to be slightly a different mindset. And then you just don't say everything works out in the long term, right? You might have to make certain course corrections then too. So end of the day, a crisis tests your emotion than anything else. I don't think it tests your rationality, it tests your emotion. So as long as your emotion is in good guard, I think you should be okay. That's what I would say.
All right, so we have this question coming from Richard Doshi, and that is, Naveen, will we see Nifty at 30K first or at 20K, 22K first? 22K, oh, that's huge. So is it 22K or 30K is what Richard is asking?
See, if you give me two numbers when I just spoke to you 15 minutes back saying I think growth will come back, I will have to go for the above. So if
So 30K it is.
so, then 30K it is.
Okay. And Mr. John is asking, what is your view on ITUS for the next 3 years? What is it? What is the message that you would like to give to your investors?
The consistency of returns is what we stood for. Early this year, there was that aspect on the downside that we didn't do well, but since then the course correction has ensured that returns have again come back strong. Over the next 3 years, you go back to basics, consistency of returns, outperformance against the benchmark, which is what we have seen at roughly 4 to 5% net of fees and expenses. That's what an investor should expect from ITUS.
All right. Thank you so much, Naveen. That was great talking to you. And I'm sure it has been really, really fruitful for the audience. Just can we just, if you allow me, just can we take the last question? What is the ITUS views on renewables at the moment? And that question is coming from Mr. Arun.
So again, see, two different things, right? One is a view on a sector does not mean the stock has to do well. This is something that I always try and explain, which is why cycles actually happen. So if you ask me my view on renewables, obviously I'm very bullish on renewables because there is a power, you need multiple sources of power over the next few years in order to power your actual GDP growth and demand and what is happening from a data center perspective. Does that mean that you invest in solar stocks? I'm not very sure about it because end of the day, power is a depreciating asset. So you will invest aggressively in capex. Does that mean each one of that capex addition is going to result in incremental ROIC? I'm not a buyer of that. So that's my view.
Right, point taken. And so, friends, we're coming to a close of this webinar, and I'm sure that this has been very exciting, very meaningful, educational, learning from the horse's mouth himself, and taking the advantage of all the experience that Naveen has for over 2 decades. Just before we log out, we're going to have a rapid fire for you. Naveen, are you ready? And we would like to have a shorter, crispier answer for this.
Done, Narendra. Sure.
Okay, so you have to select something from the question that I give you, and you have to select it in a snap, and that will show how well prepared your mind is towards your capital and towards your PMS. So when I say large caps or mid and small caps, select one.
Multi-cap.
Okay, gold and silver, select one.
Gold.
Okay, quant and human, select one.
I operate in the middle, so it's hard.
So it's both, yeah. So it's a combination of quant and human that comes in, right? And that's not the 2 decades of Naveen's experience with coupled with the quant is what makes a dashing combo. Yeah. Okay. Banking sector, healthcare, select one.
Healthcare.
And of course, the last question was that Richa has already asked. So I'll ask a little more neutralized question than Richa's, and that is 25K or 30K Nifty.
I'll still say 30K because I'm an optimist.
All right, that's great, Naveen. It was great talking to you. Thank you so much for your time, and the viewers, thank you so much for logging in. And Wealth One is one such platform which will continue to keep on getting the best of the brains of the financial markets, the fund managers for PMSs and AIFs onto this platform so that everyone can benefit from their knowledge. Do visit Wealth One website, the Instagram, the YouTube, and we would love to hear from you. whenever for any queries, just get in touch with us because we work on the space of PMS and AIF. Thank you so much, everyone, and have a great day ahead. Thank you, Naveen.
Thanks a lot, Naren. It was a pleasure talking to you with all the questions. Sincerely appreciate this. And thanks to all the viewers who logged in as well.
Thank you. Thank you so much. And we sign off from Returns and Beyond at Wealth One. Thank you.
Have a lovely day.